Good afternoon, ladies and gentlemen. Welcome back to the 3rd of February, the first weekly market review for the month of February. Firstly, I'd like to wish everyone a very happy Chinese New Year and Gong Xi Fa Chai. Happy New Year to Mr. Gerald Wong as well. I hope you are in good health and your business will prosper this year. Again, how are you, Gerald?
Hi, Sunny. Wishing everyone happy Chinese New Year as well. Hope all our viewers will have a very white year of the snake, and of course, good health as well as prosperity. Same to you, Sunny. Wishing you good health and prosperity in the year of the snake.
Yes, this has been our Chinese New Year custom. We always remember to bring oranges. Okay, so today we got some heavy news because of what Donald Trump announced over the weekend. And I'll let Gerald take you through some of the impacts of Donald Trump tariff war, which just started on last Friday night. Okay, so Gerald, over to you.
Okay, so as usual, before we start, the usual disclaimers that today's sharing is for information purpose only and should not be taken to be financial advice. We have an upcoming Ask SIAS on the 12th of Feb. That's a Wednesday. So if you have got any questions for myself and Sunny about the developments in the market, about DeepSeek, about the tariff war, do join this upcoming Ask SIAS, where you'll be able to get these questions answered. If you find the weekly market review helpful, do leave us a review on Google. And if you are keen to improve on your financial knowledge this year, want to access more online resources, investor education programs, you can join SIAS as a member, either by scanning this QR code or by going to the website sias.org.sg/membership. Okay, so we start with a recap of the market over the past week. While many of us were busy celebrating the Chinese New Year, we saw quite a bit of volatility in the US markets. Okay, so the S&P 500 was down by 1%. And as we can see from this table, the losses were led by the tech stocks, particularly the names that were linked towards artificial intelligence or AI. Closer to home, the STI actually had a decent performance with a 1.4% gain in the past week. Okay, so what we saw was really the sell-off in AI-related stocks, particularly the chip manufacturers. And we see here NVIDIA, the close to 600 billion decline in market value on Monday, 27th of Jan, represents the biggest one-day fall in market cap in history. Okay, so you might be wondering why did that happen? So I'll do a quick recap around what led to this decline in NVIDIA share price as well as AI-related names. Okay, so we have got this Chinese AI startup that's called DeepSeek. It is known to be a cost-effective AI model through its R1 model. And if you're familiar with ChatGPT, it performs a similar function to ChatGPT. Okay, but what is most interesting is that the R1 was developed at just a fraction of the cost that is being used to train OpenAI's ChatGPT. Okay, so according to its technical report, R1 was trained at just about $6 million, and that would be significantly lower compared to what was the cost that was used to train ChatGPT. So what this has actually led to would be investors re-evaluating the AI sector and maybe suggesting that a lot of what is being done in the AI industry may not require such massive investments, particularly in the very high cost NVIDIA or the other advanced chips that are now being used to train these models. Okay, so that led to a sell-off in the names that are linked towards the AI chips, including NVIDIA, where we saw the 580 billion sell off in the stock in one particular day. Okay, if you look at the Singapore performance, what we saw is that the STI outperformed. We have some names such as Singtel, DFI Retail Group, DBS, Hong Kong Land, and Yang Zhejiang, which had gains of 2% or more. So these are the names that are not as impacted by what has been the key development in the past week around the news on DeepSeek. But on the other hand, if you look at the worst performers, we've got Mapletree Industrial Trust that was down by 4.5%. Likewise, for a number of REITs that are linked to data centers, we saw a sell-off in the past week due to concerns that with the development of DeepSeek, we may not require as much data center space to be able to accommodate a lot of these applications. Okay, so I'll go through two names today. The first is Mapletree Industrial Trust. We see here that it went ex-dividend in the past week, but at the same time, we also had the sell-off relating to the concerns around DeepSeek. And we see that it is now at about $2.10, which is actually at the 52-week low. Okay, so just as a recap on Mapletree Industrial Trust, we see that it has got a significant portion of its portfolio in data centers. That now represents 56% of its portfolio. The bulk of it in North America, which is 46.1%, Japan at 6.6%, Singapore at 3.2%. Okay. And then it's got some other industrial assets in Singapore, such that overall Singapore would make up about 47% of its portfolio. North America, which is largely the data center assets, will make up another 46% of its entire portfolio. So we also saw Mapletree Industrial Trust reporting its most recent earnings, and what we see here is that it has still been fairly resilient in terms of the distribution. The gross revenue was up by 2%. That is largely due to the strong performance of the Singapore assets. And then that led to an increase in the net property income of 2.6%. And all in, we are looking at an increase in the distribution per unit by 1.5% to 3.41 cents. Okay, so that still reflects fairly resilient distributions compared to some other REITs. But if you to look at the underlying performance, then there might be some things that I'll be mindful about. So the first is the portfolio occupancy that we see here. In terms of the overall portfolio occupancy, it declined from 92.9% in the previous quarter to 92.1% in the most recent quarter. Okay, and if I were to look at the performance across different segments, the data center occupancy rate has declined from 91.9% to 91.6%. And then in Singapore, the business park buildings, occupancy has declined from 80.6% to 80.1%. Okay, so with that, we saw a decline in the occupancy rate of the entire portfolio. Okay, what is then on the more positive side is that in terms of the balance sheet, Mapletree Industrial Trust continues to maintain a fairly healthy balance sheet, where we see that the aggregate leverage ratio remains below 40% at 39.8% as of December 2024. Okay, in terms of valuation for Mapletree Industrial Trust now at about 1.2 times price to book, which is above the historical average and sector average. If I were to look at the dividend yield, currently at about 6.2%, because the price of the REIT has come down, even though we see that the distributions, as reflected in the last quarter, has been fairly resilient. Okay, so that is Mapletree Industrial Trust. Next, I'll talk about Keppel DC REIT. We saw this very sharp fall in the share price of Keppel DC REIT on Monday, with the sell-off in the AI-related stocks. But thereafter, it has recovered on Friday to close at about $2.20 per share. Okay, so what we see for Keppel DC REIT would be a fairly strong increase in distributions. If I were to look at the gross revenue, it was up by 8.8% in the second half of 2024. And then if I were to look at the distributable income, it was up by 20.2%. And overall increase in distribution per unit by 13.2% to 4.902 cents in the second half of 2024. Okay, so this is a much sharper increase in the distribution per unit compared to what we saw for Mapletree Industrial Trust. Okay, what we do see for the overall portfolio occupancy remains healthy at 97.2%. Okay, the other key development for Keppel DC REIT to be mindful of is that if you to look at the acquisition, recall that they did a big equity fundraising in the fourth quarter of last year to acquire two data centers in Singapore, the Keppel DC Singapore 7 and 8. So what the company shared is that the acquisition has been completed on 27th December 2024. So that is something that will contribute towards its distributions in the coming years. Okay, if I have to look at the balance sheet of Keppel DC REIT, the aggregate leverage is low at 31.5% after the equity fundraising that was done. And if you have to look at the average cost of debt, that has come down as well to about 3.1% in the fourth quarter of 2024, versus 3.3% for the whole of 2024. Okay, if I were to look at the valuation of Keppel DC REIT, now about 1.6 times price to book, which is above the historical average as well as the sector average. And if I were to look at the dividend yield, now about 4.1%, which is below the historical average as well as the sector average. Okay, so what to look out for this week? As Sunny shared earlier, we had the news over the weekend around the tariff war. So we'll continue to keep up about the macro developments there around what Canada, Mexico, and China will do in response to the tariffs that were announced by the US. At the same time, we go into the earnings season in Singapore, with a number of REITs continuing to report their earnings. And likewise, SGX Capital will also be reporting their earnings this week. Okay, so with that, I'll hand over to Sunny, who will share with us the technical analysis and how the charts are looking at now at this point in time. Over to you, Sunny.
Okay. Okay, thanks, Gerald. So let me take a deep breath first before I start to share with you some of my opinions. I may talk a little bit more today because I have some thoughts on my mind that I want to share with you guys. Okay, so first thing first, we saw the last Friday Donald Trump started the tariff war with the 25% tariff on Mexico and Canada and a 10% tax on Chinese goods. So the first question that we started today before we started the show, I was to ask Gerald. So didn't we see this coming when Donald Trump was elected? So when people chose him to become the president, it is expected that he will likely start a trade war. So I would not say that this is totally unexpected, but definitely there could be some overreaction in the market right now. Okay, so last Friday, the indices were down, but then you can see that this morning, the US futures are also down right now, around the 2% mark for the Nasdaq Composite, and the Dow was down 1% now. So, but I did want to do a recap of how the whole January performance for the US indices first. So I believe the outperformer was the Dow Jones Index, which was up 4.7%, and then followed by S&P and Nasdaq with about 1 to 2% gain. So what happened on Friday technically erased all the gains that we saw in January. But then technically speaking, the uptrend that we saw in the past 2 years is still intact. Okay. And on the Singapore side, right, let me look at the Asian markets right now. This morning trading on the 3rd of February, STI was up 1.4% last Friday. And then today is just down 0.5%. So not really giving up all the gains that we saw last Friday. So I would say the pullback was expected but it is still rather muted and now still holding on to the 20 days moving average. The Asian index, the Hang Seng index as well, is down about 1.8% right now. Earlier it was 2%. So looking at some of the global indices right now, the tariff war that started caused around a 2% drop in global indices. Okay, and Singapore being a safe haven is much less impacted compared to the other bigger economies. Okay, so my thoughts here is on the Singapore market. Donald Trump started the trade war. I have managed to browse through some of the economist report this morning. EY and Barclays was saying that probably this trade war and the retaliation that we might see in the coming weeks will cause a 1% or 1 to 2% jump in the inflation reading in the US. And that could mean that we are unable to see rate cut anytime soon in the short term and the mid term, and probably closer to the year end. Probably we have a chance to see a rate cut. So if let's say interest rate were to increase, yes, and inflation rate were to increase, then I would say on the Singapore market side, the REITs will be in for a much rougher ride. So, but thankfully, as what Gerald shared earlier, and back to how I remember my finance class, the performance of the REITs which have their earnings coming up next week, right, will definitely show that they still have a very robust financial performance. That means their financial are still very healthy. They could still manage their leverage and their debt. So it's not a concern whether they can be an ongoing basis, but rather, as a technical analyst myself, markets are not only dictated by fundamental financial performance, it's also affected by market sentiments. Hence, I like to look at the technical aspect of things on the market. So that would create this environment of high interest rates and high inflation will continue to create a very huge pressure on the Singapore REITs sector, and adding on to the DeepSeek developments, which push down the data center even further. I think in the first half of this year, the REITs will be under a lot of pressure. Okay, so these are some of my quick thoughts off my mind when we see the recent developments over the weekend. And on the cryptocurrency front, I always use crypto Bitcoin as what they call a canary in a gold mine. Whenever something is wrong in the gold mine, this birds called a canary will definitely fly out first. So Bitcoin was down below the $100,000 psychological mark. It touched around the 96,000 US dollar this morning. So that means that, hey, the whole market is in a risk-off manner, a risk-on sentiment right now. Okay, so having talked about some of my thoughts and opinion, let me go back to analyze the charts for you so that you don't overreact. Okay, and we will walk through this. We will handhold you together through this rough ride in February. Okay, on the STI index this morning, now we are down about 0.7%. You can see that we almost was able to challenge the high that we saw in early part of January at the 8,086.87 points level, but then after that we pulled back this morning because of what happened on Friday after Trump announced the trade war. You can see that the STI index did not really pull back that much as of now. I would say it is still holding on to the 20 days moving average, which is the Bollinger Band basis, the black line that you see here. Okay, that is around the 3,812 points level right now. So the 3,800 level will be a key support for the Straits Times Index for now. But you can also see that I have drawn this parallel trend channel. It is STI is on a very strong uptrend in the second half of 2024, and we more or less sort of broke below this price channel already. And so this means that likely in the near term, in the month of February, we will be likely seeing of 3887, and the lower support is on the 50 days moving average, or the lower bound of the Bollinger Band, now around the 3,750 or 60 points level. Okay. On the indicator wise, so MACD is slightly lagging a bit, although we still see a slight positive momentum. But if you look at the trajectory of the MACD line and the signal line, it's pretty much sort of pointing in a sideways direction. There's not much of an angle of attack or an angle of slope that we are seeing now, both on the MACD and the signal line. So this signals to us that likely what we will see in the near term on the STI will be a sideways trading pattern. On the RSI, we hit a high reading of 61 point last Friday. So 60 point is actually a very healthy level. And after the 1.4% gain that we saw last Friday, it's actually on Friday before the tariff announcements, it was looking very good and looking on track to create a new 17-year high. But then this morning, we had that pullback. The reading is now at 55, so closer to the 50-point mark. That would mean that the uptrend momentum has actually subsided quite a bit for now. So that means that it is closer to the 50-point neutral reading right now. So the indicators are agreeing that the MACD and the RSI are telling us that, hey, there is not much of any momentum in either direction right now. So likely we are going to see a range-bound kind of formation on the STI index with the support around the 3760, 3750 level, with the top side at the 17-year high at 3887. Okay, that is the Singapore side of things. Let me go over to the US right now. So Dow Jones Index was the outperformer for the month of January, as you can see over here. Where are my trend lines? There you go. Okay, so start of January, let me mark this point over here. So this is the start of January. You can see that Dow Jones performed very strongly in the month of January, which is usually the behavior of the Dow Jones Index in the month of January, because we are in the earnings season right now, and usually the US earnings season we start off with the big banks, which have shared they have very strong performance again. Okay, this for the last quarter. Hence, Dow Jones with the financial big names in their weightage, so has a very good performance in the January period. We also come very close to the December high. But then we just missed off by sort of, let's say, about 20 points, because the high I saw on Friday midnight, which I remember very clearly because I was watching the market before I sort of choked on my bagua a little bit when Trump announced the tariff. So it was at the high on Friday, it was 45,054 points. There you go, that reading over there. And we are about 20 points away from the Dow Jones Index high that we saw in December. And I was actually looking very closely to see that it will be able to close at a all-time high again, following what S&P 500 did the previous week. But then that did not happen, because after the midnight, after 1 a.m., the news came out, markets pulled back straight away. So on the Dow Jones Index, it is still looking very healthy and elevated, although we see that in the past 4 or 5 trading sessions, that momentum has started to come down according to the MACD indicator. You can also see the converging of the MACD line towards the signal line, thereby signaling that we are going towards the end of the uptrend that we are seeing in January. Okay, the uptrend momentum has started to subside, and then we might likely need to revert to the mean, and that is the average of the 20 days moving average now at 43,524 points. So the Dow Jones Index is still supported by the 100 days moving average, which is at 42,879 points, with the final support level, which is the lower bound of the Bollinger Band, finding the confluence with the 200 days long-term moving average at 41,500 points. So for Dow Jones Index, I believe if you have invested take a long position at the beginning of January on the Dow Jones Index, you should be taking some profit off the table and wait for it to revert back to the mean or slightly below the average of the 20 and 50 days moving average. Then you can accumulate back again on the Dow Jones Index. Next, the broad index S&P 500, which was also up in January. So the line is there. Okay, so you can see that January is performed very well. It was helped by the big banks' performance. It was also helped by some of the tech names that announced last week, like Apple, Microsoft, and which is the one. Okay, some of the tech names that reported last week, which shows that there is still very good growth momentum, although not those kind of very exponential growth that we saw in the previous few years on the tech names. But growth is still growth. The tech sector is still growing. The tech companies are still growing, but just at a slower pace. It also helped the S&P 500 to come close Actually, it was just 10 points below the all-time high of 6128 at around 611 something. Then we have a pullback again on Friday. So that is the concern that the market has right now on Donald Trump tariff plans, and also expecting some of the retaliation actions that will be taken by Mexico, Canada, and China. So S&P 500 pulled back to around the 6,040 points level, supported by the 20 and 50 days moving average, now finding a very good confluence around the 5,979 points level. So about 20 points below the 6,000 psychological handle. And the 100 days moving average is now currently at the 5,860 points level. So these are the two key levels that you should be looking out for. And in such a, as of now, I would say is in such an uncertainty kind of a period, because we don't know what the retaliation action would be and what other tit for tat action Donald Trump or US may take after that. So I believe investors would need to be more prudent and more conscious, and give yourself a bigger a buffer or margin of safety. If you want to look at the S&P 500, do accumulate closer to the 100 days exponential moving average, which is the amber line that you'll see here, around the 5864 level or 5850 level, which is also somewhere closer to the low that we saw on 13th of January, in the early part of January. So use the 100 days moving average or the lower bound of the Bollinger Band as a support for S&P 500 to get back in if, let's say, we really pull back towards that area. Okay. Lastly, the most impacted index is the most volatile one, and that's the tech-heavy Nasdaq Composite Index. So as you can see over here, Nasdaq Composite Index, okay, this morning was down the most, 2.22% according to the Nasdaq futures. I'm using the cash index as an illustration right now, okay, because we are looking at what happened on the last Friday close. So this is what happened. You can see that among the indices, okay, among the 3 US indices, of course, the Dow Jones Index was the best performing one, up 4.7% in January. So we did not really give back all of those 4% as of now. We only give back around 1 to 2%. So half of the January gains will give back for the Dow Jones Index. But then if you look at the Nasdaq Composite Index for the year to date, or for the past 1 month, is up just 1.15%. And today we are down 2%. So technically, Nasdaq index is in the negative for the year right now. Okay, so you can see that the Nasdaq index has already pulled back. Okay, let me put in my charger. Okay, okay, the Nasdaq Composite Index has already pulled back close to the 20 days moving average already, and that is around the 19,565 points level, just about 100 points away from what we saw on last Friday close, with the 50 days moving average at 19,427 points, very close by. Okay, so the next level of support for the Nasdaq Composite Index definitely is the 100 days moving average, which is the amber line that you see here at the 18,960 point levels, supported also by the lower bound of the Bollinger Band at 18,993. So the 19,000 handle will be a very strong psychological level for the Nasdaq Composite Index. And as for myself personally, in my own opinion, as what I said in earlier part of the year, I still believe that the AI, the tech sector will still be a theme. DeepSeek will definitely come in to disrupt, but then definitely the OpenAI and the other tech sectors will need to level up their gain as well. So if Nasdaq retrace back to the 19,000 handle, I am inclined to sort of add on further, to accumulate further on the Nasdaq Composite Index for my position in my portfolio. But indicator wise, you can see the MACD indicator is slightly negative right now, and for the past few trading session, past 4, 3, 4, 5 trading session, it has been sort of in a sideways trajectory. So meaning that index are likely going to move in a sideways direction in the near term, in the next couple of weeks, or even to the end of February. The RSI confirmed that with a reading of just 50, exactly at the 50-point neutral mark. So we don't really see any kind of a indicative direction of where the market will move right now. And I believe that is in line with what the market is telling us. Let's do a wait and see approach and see what the further actions that Trump will announce later on. Okay, he can on the tariffs today, he can turn it off tomorrow. So we have seen some of his action in the first presidency, and now this is the second one. So it will be a rough ride for February, but we will hold you through for the ride, and we will be here sharing with you every Monday. Okay, Gerald, your opinion, your thoughts on tariffs and DeepSeek on the markets.
Well, I think going to 2025, one of the things that we did share about is possibly more volatility in the markets because of Donald Trump's policies, and also because we see that for the markets, they are also having 2 strong years of performance, particularly in the US. So I think that is something that investors need to brace themselves for. And like Sunny, you shared earlier, we need to ensure a larger margin of safety to make sure that we can go through some of this volatility and be able to have a resilient portfolio to meet this volatility.
Yes, with that being said, Singapore is always viewed as a safe haven, although I'm concerned about the REITs, but there are other names that are still very strong. And with I just like to remind, with high inflation rates, with high interest rates, I believe you know which are the counters that will perform well in the Singapore markets. Okay. So I think that's all that we have to share for today. Like to wish everyone a very happy new year again. And everyone do trade safe and stay safe. And we will see you again next week on Monday in the next weekly market review. Goodbye.
Thank you.
Thank you.